Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra, and with me is Reema Tendulkar, and these are the top headlines that we are tracking on Midcap Radar. Markets hit day's low, recovers a tad bit from there as stocks trade weak ahead of Jerome Powell's speech later today. All sectors apart from realty trade with losses. FMCG and autos are the worst hit.
Tata Steel slips as pressures in Europe hurt profitability, while weak sales and a sharp dip in margins of Novelis hurts Hindalco.
Adani stocks see a reversal of their selling streak. Strong results of Adani Transmission are a surprise, even as several other group entities are set to report earnings today.
Muthoot Finance slips on posting weak AUM growth, while a sharp contraction in margin hurts Balaji Ameen's. Paytm jumps following an upbeat conference call and a potential ban on other lending apps.
Okay, all right. Those are the top headlines that we are tracking. Of course, a lot of moves in the broader markets as well. As far as the Nifty is concerned, it has seen a sharp recovery from the lows. It's down 40 points as we speak. Last couple of minutes, it was seeing cuts of around 90 to 100 points. The top gainer today in terms of moves is a couple of these sectoral trends. So realty is doing really well. So that one is up around 6-10%. But Nifty Auto is the one which is declining the most. However, the cuts are not as deep as we saw earlier. So Nifty Realty has moved to the highs of the day right now. What has led to this recovery in last couple of minutes that we have seen? Well, some of these Adani names as well. Adani Ports reported numbers. We have Adani Enterprises, which is high by 16% as well. So, yes, there are pockets which are doing well. We got the Adani Ports numbers just a while back, slightly lower than estimated. But, of course, there's a rebound that we are seeing. And TCS is the one which is at the day's high, which is aiding the Nifty move as well as we speak. In the broader markets, we have Apollo Tyres, which is trading under pressure. Sonia is joining us to tell us what is really dragging the stock in trade today, Sonia.
Well, thanks a lot for that. So, there are a couple of reasons because of which the stock could be under pressure. One of them is that in the conference call, the management spoke about how the European business is under pressure and export demand is expected to remain weak in the near term. Remember, they have the Vredestein business in Europe, and they said that in the first half of the calendar year 2023, Europe will continue to be under pressure. So that's one, pressure point for them. The other thing is that Apollo Tyres has gone ahead and lowered its capacity expansion guidance. They've lowered it to 700 crores for the India business, which is 75% of its earlier guidance. Now, of course, this is positive from the angle that it will help them in terms of free cash flow generation and maintaining their ROCEs. But the fact that they have lowered their capex is something perhaps is making the street a bit cautious. The fact that they're going slow on expansion plans. So these are the two key reasons why the stock could be under pressure. But on the flip side, there are a lot of positives that the management spoke about at the conference call as well. They spoke about how the overall demand is quite strong in the OEM space, especially in passenger car radials and truck bus radials. So demand continues to be strong. On the margin front, they are expecting the input costs to correct further by mid-single digits in Q4 on a quarter-on-quarter basis, which means that this would help them in terms of their margins. And the other big positive for Apollo Tyres is that they have gone ahead and reduced their debt. So the consolidated debt has gone down to 4,800 crores in Q3 from 5,500 crores in Q2. This is because of an improved performance as well as a reduction in working capital. So there are pros and cons, but I think today the stock is under pressure because of the challenges that the company is facing in the European region. Back to you.
Thank you very much for that. One of the other big losers today is Tata Steel. In fact, the top index loser, reacting to a weak set of Q3 earnings. The company, remember, posted a net loss of 2,500 crore. EBITDA missed estimates by a huge margin. Margins have contracted on the back of weakness in the European business. We spoke to the MD of Tata Steel, TV Narendran, about how prices are shaping up in India and Europe in Q4, and also on the company's plans for debt reduction from here on. Listen in.
So you will see the negative EBITDA that we are seeing in Europe in Q3 reduce in Q4. We are not fully out of the woods yet because the demand in Europe is still a bit fragile. Q4 volumes will be higher than Q3 volumes, both in India and in Europe. So we have 500,000 tons of extra volume coming in Q4 compared to Q3. Despite all these challenges and the bad set of numbers, if you see the debt has stayed where it is at 71,000 crores, it has not gone up. This year, obviously, we also had to contend with the 12,000 crore acquisition of Nilachal, plus a lot of money which got stuck in working capital because of high input costs as well as the stock buildup in Netherlands. So we'll be releasing that cash for next year. Obviously, next year is a year when we'll get back on track, and we want to continue with our focus on debt reduction.
Okay, all right. So that is about Tata Steel. That stock is in focus today, but Cipla also is on our radar today. Ekta is joining us to tell us why. Ekta?
Hi, thanks for that. Well, yes, Cipla is in focus because they did come up with a clarification last evening. This is with regards to the IT department conducting a search, and the company has confirmed this. They have said that the IT department did conduct a search at some of their offices as well as manufacturing units. The company has said that they did cooperate with officials, and the company has responded to clarifications and details. They continue to provide any further clarifications as well as information required. The operations, they have said, had not been impacted and continued as usual. This is important because the street was speculating in terms of what the extent of the IT search was. So finally, the company, after a lot of speculation, has released an official statement this week indicating that, yes, it did take place.
Thank you very much for that. Get into a break. On the other side, we'll get you more on the market. Stay tuned. Welcome back. Let's talk about the market technicals. Shrikant Chauhan, EVP Kotak Securities, is now with us on the show. Shrikant, it appeared to be a very flat day, but somewhere around 11 o'clock, the market started declining. And now in the last 10 minutes, it's trying to find its feet. Courtesy, we're not down too much. We're down 56 points on the Nifty, but it's still a down day on the benchmark indices. How have you assessed the day so far, and what would be the trading strategy from here?
Yeah, good afternoon. I think, see, the market is it's still in the range. It is narrowing down its overall volatility. It was in the range of 18,000 and 17,400 on the downside. Now it is trying to narrowing down to the activity between the levels of 17,800 and 17,600 on the downside. Now today we need to see that whether the market manages to close above the levels of 17,700 or not, because that is acting as a equilibrium level for the market. So in case if we see the market is crossing 17,800, then certainly we can expect pullback towards 18,000 levels. Otherwise, the chances of hitting 17,500 are bright. Broadly, we need to wait and we need to see that whether the market is crossing 17,800 or not. I think stock-specific activity is certainly there, and if we focus on selective stocks, then we can make very good money.
Okay, all right. So selective stocks is what you're focusing on, Shrikant. What would your individual technical picks be in that case?
Yeah, in that we like Poonawalla FinCorp, which is currently trading around 295, 298 levels. There the stock is forming some continuation formation, and based on its formation, we are of the view that it is heading for its previous high of 330, 340. It is forming continuation formation, so at these levels, it's a buy with a stop loss around 290. We can expect 330. And the other stock which we like is Mahindra Life, which is currently trading around 380. There also we saw a good amount of price expansion as well as volume expansion. And yesterday it was around 400 levels. Today, again, it is retracing back to the levels of 380. So it's a good risk-reward ratio for positional traders to enter. It's a buy at current levels with a stop loss at 370. Again, we can expect 420, 430.
Thank you very much for that. Undoubtedly, the stock of the day today is Adani Ports. Came out with numbers. Vivek joins in with the fine print. Vivek?
Well, good afternoon. When you're talking about the results of Adani Ports, it's a slight miss as far as the CNBC-TV18 poll is concerned. The revenues coming in close to 4,780 crore versus our poll of 4,750. The EBITDA was a bigger miss, 2,695 crore versus our expectation of close to 2,950. Profitability, coming in at 1,315 crore versus the expectation of 1,600 crore. Remember, profitability was also impacted due to a one-time hit as far as the forex volatility was concerned. But more importantly, the management continued to reiterate its guidance. In fact, it's reiterated that it should be able to achieve the upper end of the stated band as far as the guidance for FY23 is concerned. What is the guidance that the company had given? Revenue of close to 19,200 to 19,800 crore. So expecting the company to hit closer to the 19,800 crore mark. EBITDA guidance was between 12,200 to 12,600 crore. Net debt to EBITDA at the end of of FY23 is expected to be around 3 to 3.5 times. Now coming to FY24, management has given quite an aggressive guidance. EBITDA is expected to be between 14,500 to 15,000 crore. The capex, the company has said, is going to be between 4,000 to 4,500 crore. And by aggressive prepayment of loans, the management believes that they should be able to get the net debt to EBITDA to 2.5 times. In fact, we have the management of Adani Ports actually talking about the guidance as well as what is it that they're expecting as far as FY24 is concerned.
Okay. All right. So as Vivek said, let's listen in as Karan Adani, the CEO and whole-time director, speaks on the guidance for the company's third quarter.
In May 2022, we provided our full-year guidance for FY23. We predicted FY23 revenue in the range of rupees 19,200 to 19,800 crores and EBITDA in the range of 12,200 to 12,600 crores. Today, I can say that with much confidence that we are well placed to deliver on the top end of this guidance.
Okay, that's the word coming in on Adani Ports. The stock has slipped from the day's high, but is still up close to about 2.5%. Numbers coming in from JK Infra. Profits are up close to 20% on a year-on-year basis at 71 crore versus 59 crore. And the improvement in profitability is despite a 10% drop in the company's top line. But let's get to the exciting news. The most coveted leadership awards are back. CNBC-TV18 honors the visionaries behind outstanding businesses. Catch the most influential, credible, powerful IBLA jury on the 8th of February right here on CNBC-TV18.
Welcome back. Well, let's get some conversations going with a chemical company now. Rossari Biotech posted a mixed set of Q3 numbers. While their revenues were down 9%, margins improved by 300 basis points on a YOY basis. But the company has gone ahead and cut guidance in terms of revenues and margins as well. We have with us Mr. Sunil Chari, who is the co-founder and managing director at the company. Mr. Chari, good afternoon. Thank you so much for joining us here on CNBC TV18. Well, you have cut the revenue guidance to 1,700 crore rupees versus 2,000 crore rupees earlier. In terms of EBITDA as well, you expect to do 230 crore rupees versus 250 crore rupees earlier. Can you tell us what went wrong? Because Q3 did see an improvement in margins, and textiles business, which was not doing so well, also saw an improvement. So what led to this guidance cut?
So one thing was our subsidiaries where we have significant exports to US and Europe. Our exports increased, but it did not increase as per what we had planned, especially because of the Ukraine war. The second thing was a softening in the raw material prices and consequent softening in the finished good prices, which was more than what we had planned. In terms of EBITDA, if you see, we did 168 crores in the first 9 months of this year on a consolidated basis, which is the highest ever EBITDA in history of Rossari. Even our quarterly EBITDA, our margins are much significantly higher, between 2 to 4% compared to quarter-on-quarter last year and year-on-year last year. So we are very pleased with what has happened. We have taken care of the volatility very well. We do not have too much stocks when the raw material prices fell. So we are happy with the performance which has happened in the last 9 months.
Mr. Chari, so let's talk a bit about exports. You're saying weaker exports to US and Europe is the key reason why your revenues came in lower than anticipated and you had to cut the top line guidance. Now, exports is, I think, about 24% of your revenues, approximately?
Yes.
How much lower is the export demand on a year-on-year basis? And is that a trend which will continue? Because it's not that growth is coming back in a big way globally right now.
Yeah, so we want to increase the exports to 30% of our revenue for the next year. The plans are that Europe is picking up now, and we should see a good amount of exports for the coming financial year.
When you say exports are picking up, what is the number for the month of January and the first week of February in terms of export growth? And
we are not able to share, the current month's performance as per SEBI guidelines.
No, but is it, no, of course we do get that, but is it better? Are you seeing some improvement? And when we are talking about taking exports to higher contribution of revenues, what is FY24 looking like now? Because you've integrated all your acquisitions. You're talking about a performance which is as per your satisfaction, but still lower than what you had guided for. So what is FY24 looking like overall?
So we feel, that we should do more than 450-500 crores next year, exports.
Okay, that is 450 to 500 crore rupees in terms of exports. And overall margins, will they continue to see better numbers, 13.9% right now? Are you seeing improvement across all the segments to go to previous level margins as well?
Yes, so if you see our last 3 quarters, there has been increase every quarter, and we are at 13.9% now. We are optimistic about margin improvements in the coming quarters too.
I believe you've guided for margins of 16 to 17% in the next 2 years. So that is an improvement of 200 to 300 basis points from here on.
Our target is to reach the 16% plus mark, in the FY25.
16. How will you achieve it? What is the roadmap?
When we have increase in sales and our costs do not increase, and also the focus has been on profitable products. We have new launches planned, especially in the green and the sustainable range, and we are seeing a good traction in the international markets for more sustainable products. So our lab in R&D is focused on a lot of biosurfactants, green surfactants, products which can reduce BOD, COD, and TDS.
Mr. Chari, if you are spending more on R&D, what is the percentage what is the percentage versus the revenues? Will that number increase? And consequently, what will that do to your margins and your capex plans as well? What are they looking like for FY24?
So we are focusing on increasing R&D expense for the next year, definitely compared to the current year. As we have said that we do not do core molecule R&D. We focus on innovations in formulations to help our customers reduce either the BOD, COD and TDS, or the generation of effluent, or reduce overhead cost by reducing power, by reducing steam consumption, by reducing water consumption. So we see definitely higher amount of R&D expense next year.
Okay, Mr. Chari, we'll leave it at that. Thank you very much for joining in. That's Rossari Biotech. Q3 numbers were muted, hit by lower exports. That's the reason why the company has lowered the FY23 revenue and margin guidance. But they're confident that things are picking up. Exports have already started picking up. The contribution from exports will also rise to 30% versus 24%. And consequently, the company is gunning for a 15 to 16% top-line growth and EBITDA margins above 16% in the next 2 years. That's Rossari Biotech for you. The stock is a bit subdued in trade. Well, we're out of time on Midcap Radar from the entire team. Thank you for watching Mutual Fund Corner when we return.